and good morning to everybody. And thank you very much again for Santander and Anna for the invitation. Obviously, for me, it's a really special day and a real pleasure to be here today with so many friends, so many former colleagues, so many former students, and be home at the same time. So I really appreciate the fact that I have the opportunity to be here. It's hard to follow a discussion on global security issues with such an authority as we just heard, and then go on and talk about banking regulation, But I think that you are a bank. Santander, as far as I know, continues to be, apart from a city, also a bank. And it's also probably useful that we discuss a little bit about banking regulation. In my remarks today, I would like to focus about one specific aspect of banking regulation within Europe and the work that we do at the European Banking Authority in this area particularly, and mainly about the area of ESG. And within ESG, I really will focus mainly on environmental, and within environmental, I will focus my remarks mainly on climate, because as you know, climate change and sustainability are now widely recognized as the key challenges for the economy and the financial sector as part of the economy, I would say in Europe, but probably more broadly as well in the world. They have become certainly top priorities in the European policy agenda. I would probably say that's the top priority in the economic policy agenda in the European Union. And I think over the last few years, it certainly has become also a top priority across the world more widely. Now, in that part, building sustainable and transparent and efficient financial markets that would facilitate the change of our financial and economic structure going forward is ensuring at the same time that that transition to a more sustainable economy will be effective and at the same time timely and to the benefit of all of us. At the same time, as we think of this, I also believe very strongly, and this has been discussed this morning, that this is usually a risk, and we think at the EBA that that's the appropriate way to think about it. It's a risk that needs to be measured, identified, measured, managed, and accounted for. And for that, the financial sector obviously is in a unique position because the financial sector is the natural sector in society to assess risks, specifically financial risks, but more broadly all economic risk as well. So that's the way, as I said, that we evaluate this in the European Banking Authority, that we approach it as a risk that needs to be managed. But at the same time, I also believe, and this has been said before, that with risk come opportunities. I also think that this is an important opportunity for the European financial sector, for the European banks, because if we get this right, and if we really think this is a risk that needs to be managed, that it's a risk that's going to be very important going forward, and by pushing this agenda, we become better at managing these risks, that will mean that the banks and the European sector will get a competitive advantage over the medium and long term, as this risk, as I said before, goes from being primarily the European agenda to the global agenda, a salient risk that needs to be managed. So the integration of ESG risks in the regulatory framework, from our perspective, which is our responsibility, we're responsible for building the regulatory framework for banking in the European Union, includes developments on all areas, on disclosure, on risk management, on supervisory practices, on stress testing as well, and also enhancement, of course, of the regulatory prudential framework where needed, as well as other particular areas as to avoid with the regulatory framework clarifications of what the proper taxonomy is, what could be considered as greenwashing or not greenwashing. So what I like to is I would like to briefly explain to you how we're working in these areas. Starting with the area of transparency and market discipline, banks already know, or as people say in the industry, Pillar 3 requirements. Banks in Europe since 2023, since the years they have begun disclosing quantitative and qualitative information following requirements that we put forward as the European Banking Authority with a reference date of the end of last year. We hope that this will certainly contribute to the availability of ESG data, one of the most acknowledged deficiencies that we currently have, the quality of which that data will obviously, I think, increase and improve progressively over time. I always like to say, that we put forward these Pillar 3 requirements. I'll be very, very pleased if we have to revise them as soon as possible, because it will mean that we have enhanced our ability to measure and disclose in this area. That would be important. And at the same time, we're working in this area of disclosure very closely with other initiatives that are happening, not just within the financial sector, the regulation going on, that what we call horizontal across all the corporate sector, but also in Europe, but also at the same time the agenda internationally as disclosure becomes part of the discussions, particularly in our context, in the context of the Basel Committee, which established banking supervision. Now, going forward, we also expect beyond disclosure that banks are and continue to enhance and strengthen the risk management systems to better identify, manage, and report on ESG risks. This was already our goal since we started this agenda back in 2021. By now, we know we have initiated work in updating several of our own guidelines, which is the regulatory product that we put forward to banks to include ESG risks. This including the guidelines on loan origination at the beginning of the lending process, on the internal governance, on remuneration policies for managers, and on the SREP, on the supervisory review and evaluation process. All those guidelines already are introducing ESG concepts into it. We're going to continue in that agenda and put further requirements on institutions on how to account for ESG risks, and we probably will do that in the areas of, again, in the area of risk management, within risk appetite, with how to assess internal controls, on the design of ICAPs within the institutions, and also on management financial risk, particularly with a strong focus in the short term on transition plans that are consistently with other provisions existing in EU legislations. Now, when we think about prudential treatment of exposures, so particularly Pillar 1, we have recently published a report that I hope you all read carefully, and I will look forward to getting your comments on this, in which we set back basically what we consider to be the role that environmental and social risks play in the potential framework for credit institutions. Here, our approach, our key approach, I will not go into the details, remains grounded on the idea that risk-based considerations aim at accelerating the integration of the measurement of this risk into the prudential aspect of banks is key. That at the same time, we need to make sure that that risk measurement takes into account what's already in place in the existing regulatory framework. What are the part of these risks that are already being introduced through the regulatory process through other risk metrics, either through the credit risk categories, through the market risk, or through the operational risks. You know, we also need to think about additional potential challenges that we have confronted when assess this current risk going forward. And if I may focus on two that are particularly salient, I think one is the fact that the concentration risk, when we think about climate risk, may be a significant different nature. In the past and in the future, the banking model will be based on the idea of diversification of risks. We have established and we have clear categories for certain types of risk. I mentioned credit, I mentioned market, I mentioned operational. We also have clear identifications for potential concentration risks. As we think about climate risk, it's likely that those concentrations may have shifted because some of those portfolios, some of the traditional categories may actually have now different degrees of correlation as a result of the different concentration risk. Second aspect that we think is important going forward is more methodological. A lot of the prudential regulatory framework is based on historical data and time series to test existing models. This is an approach that we think for the appropriate assessment of climate risk is not proper. We need to have the ability and the tools and the mechanisms to be able to incorporate to the prudential framework forward-looking methodologies. We need to be more willing to be relying on the stress testing, on simulation exercises, on forward-looking indicators. Some of them are already built into the framework, like a lot of the credit ratings are forward-looking to a high degree, market prices may be forward-looking, but we need to go beyond that and be more comfortable introducing forward-looking regulations. Now, if I may, beyond the prudential framework, very quickly on the minute that I have left, we have other two areas that are important for us in our agenda. One, in trying to identify and provide infos on what will be considered as green loans, on green mortgages, particularly in the areas of SME and retail, particularly for households, where we think that it's obvious that the development in having the capability of starting with the process I did before, having data disclosure by the counterparty, by the borrower, it's very unlikely, very difficult for SMEs to do that, and for individual households to do that. There we need to develop a little bit of a regulatory framework that will help in identifying what's considered a green loan or what are characteristics that may be helpful to understand what could be considered as green or less green, or like people like to say, and I'm quoting a former governor of the Bank of England, Mark Carney, a strong leader now on this agenda worldwide. There may be 1,000 shades of green as well out there. And the second aspect in which we've been working on the other side is we're working also on what's a common definition of what could be considered greenwashing. As we go forward, we need to make sure that we distinguish talk for action, that we distinguish well-intended intentions for not so well-intended intentions. And we will be coming forward by the beginning of next year with the other supervisory authorities in Europe with a common definition of greenwashing, with a common understanding of what could be a definition of greenwashing in the context of the financial sector. So let me stop here. Thank you very much for your attention. I would just conclude by saying, please keep in mind that this is a very important agenda. It's an existential challenge for our societies, we think, and it's a challenge where we think that the financial sector is not particularly less prepared or more prepared. It's just like the rest of society. It needs to get prepared and it needs to manage this risk, and that's unique for the financial sector. Thank you very much for the invitation. It's a pleasure to be here.